What a brutal day for tech, especially for the AI darlings. If you were watching Micron or Alphabet today, you probably felt that whiplash. Let's break down what happened, what it means, and most importantly, what to do next. First, let's look at the damage. Micron, symbol MEU, got absolutely hammered. It closed down nearly 10% at around $379. But the closing price doesn't even tell the full story. The stock swung from a high of over $422 down to a low of $364. That is a massive, violent range. This wasn't just a gentle slide. This was what traders call a risk-off tape, where people are rushing for the exits. To put this in perspective, the broader tech sector, represented by the QQ ETF, was down about 1.75%. The semiconductor index, the SOXX, was down over 4%. So, Micron's nearly 10% drop was more than double the weakness in its own sector. This tells us it wasn't just the market falling. There was specific, intense selling pressure on MEU itself. This looks a lot like forced selling, heavy profit-taking, and major players de-risking their portfolios. Then, after the market closed, we got earnings from Alphabet, or Google. Initially, the stock dropped about 2% in after-hours trading, down to around $333. It also had a wild range, from a high of nearly $348 to a low of $309. The headline that spooked everyone was their capital expenditure, or CAPEX, guidance. Alphabet announced they plan to spend between $175 and $185 billion in 2026. Investors heard that number and immediately worried about the massive cost of the AI arms race, even though the rest of the report was fantastic. And the numbers were strong. Google's cloud business grew an incredible 48% year over year. They beat expectations on both revenue and earnings per share. So we had a situation where the underlying business performance was great, but the market got scared by the future spending commitments. So the big question is, was today's bloodbath in Micron a signal that the top is in for AI stocks? Or was it just a violent shakeout? One really ugly day doesn't automatically mean the party's over. It could be a local blow-off top, where the last buyers get exhausted. It could be a shakeout designed to scare weak hands before the price rebounds. Or it could be the very beginning of a longer-term trend change. The key is what happens over the next few days and weeks. If Micron fails to reclaim the levels it lost today and continues to make lower highs and lower lows, that's a sign of real technical damage. On the other hand, if it stabilizes, maybe drifts a bit, and then reclaims a good portion of this drop on normal, healthy volume, then it looks more like a shakeout. But let's be clear, today, on its own, is not enough to call a top. What it is enough to say is that risk appetite for the hottest AI and semiconductor plays is definitely fading this week. And what about Google? Is the earnings report good or bad? Well, it's both. The fundamental data, like that massive cloud growth and the revenue beat, is objectively good. The business is firing on all cylinders. But the market narrative is currently very sensitive to costs. The CAPEX shock made investors question the profitability and margins going forward. So we have good operating data clashing with a nervous market narrative about spending. Now, how are these two stocks, MEU and Google, connected? In the short term, they are very much linked through this AI CAPEX and risk appetite channel. When the market gets nervous about the cost of building out AI infrastructure, it tends to sell both the platforms spending the money, like Google, and the suppliers providing the hardware, like semiconductor companies. It is a classic case of selling the leaders and the most crowded trades when fear takes over. Longer term, however, their fundamentals can diverge. Ironically, higher AI spending from companies like Google is actually a massive long-term positive for semiconductor demand, including the memory chips that Micron makes. But in the short term, if the market is de-risking and everyone owns the same stocks, that fundamental story gets completely ignored. The positioning and the flow of money dominate the price action. This is where a little bit of wisdom from someone like Charlie Munger comes in handy. He would likely look at a day like today and say something like, when people get emotional, prices get stupid. He'd also remind us that our job as investors isn't to predict every single tick of the market. Our job is to build a portfolio where we are never forced to sell at the worst possible time. So don't confuse one violent trading day with a permanently broken business. The demand for AI isn't going away. But at the same time, don't pretend that this kind of volatility isn't real or that it doesn't have consequences. It's a sign that the environment has changed. So what should you actually do over the next 1 to 2 weeks? Here's a realistic, actionable plan. First, and most importantly, treat this as a new volatility regime. The calm, steady uptrend is on pause. This means you should reduce any leverage you might be using. This is not the time for big, heroic bets. Don't go all in, buying the dip on a single day's move. The market could easily go lower before it finds a bottom. Second, let's use a simple 3-bucket framework for your portfolio. Bucket A is your core, boring, high-quality holdings. If you own a name like Google for the long term, and I'm talking years, not weeks, then you should probably just hold on through this noise. The operating metrics were strong. The business is solid. The short-term fear about CAPEX shouldn't derail a multi-year investment thesis. Bucket B is for your cyclical AI suppliers, like Micron and other semiconductor stocks. Micron just proved it can swing 10% in a single day. So, if you're holding it, make sure your position size is small enough that you can withstand that kind of move without panicking and selling at the low. If you're looking to add to a position or start a new one, do not make one giant buy. Scale in slowly. Maybe make 3 smaller buys over the next 1 to 2 weeks. This averages out your cost and reduces the risk of buying at a temporary peak. Finally, Bucket C is the no-thanks zone for the next couple of weeks. This is where you put the most speculative, high-beta AI names. I'm talking about the stocks that move almost entirely on narrative and headlines, the ones that gap up or down 10 to 15% on a single news story. In a risk-off environment like this, those are the stocks that get hurt the most. It's best to just avoid them until the dust settles. And third, here are 2 simple signals to watch that will tell you when things might be getting better. First, watch the SOXX, the semiconductor ETF. If the entire sector keeps sliding day after day, it's going to be nearly impossible for a stock like Micron to mount a sustainable bounce. We need to see the sector stabilize first. Second, watch how Google's stock digests this earnings report. If, over the next few days, investors start to accept the CAPEX plan and refocus on that incredible cloud growth, it would be a very positive sign for overall market risk sentiment. If the market can look past the spending and reward the growth, that tells you confidence is returning. So to recap, it was a wild, painful day, driven by fear around AI spending and a general de-risking in crowded trades. This isn't necessarily the end of the AI boom, but it is a major warning shot. The market environment has shifted to higher volatility. Reduce risk, be patient, scale into positions, and watch the key signals from the semiconductor sector and market leaders like Google to guide your next moves. Thanks for watching. If you found this breakdown helpful, be sure to like and subscribe for more analysis. See you next time.